Welcome to The Debate. Imagine buying a stock, right, seconds after a company announces record profits and rising revenue, only to watch your investment just drop rapidly before your eyes.
Oh, yeah. It is incredibly frustrating.
Totally. And if you are listening to this and you have ever traded an asset on a great headline only to get burned 5 minutes later, you know exactly the pain we are talking about.
Right. It feels like the rules are broken.
Exactly. In almost any other discipline, positive inputs create positive outputs. You add a positive number to an equation, the total increases. But when you step into the world of financial markets, that intuitive reality breaks down entirely.
It really does. Good news can trigger an aggressive sell-off, and terrible news can spark a massive rally.
It's the ultimate counterintuitive environment. You can observe a scenario where a company reports declining sales, cautious corporate guidance, and boom, the stock rallies aggressively right out of the gate.
Yeah, the words printed on the page simply do not match the immediate directional reaction of the asset. If you try to allocate capital based on common sense alone, assuming good news equals a rising price, you will find yourself trapped very quickly.
Spot on. And that brings us to the core tension we are examining today. When a stock falls on record revenue or rallies on lower sales, what actually governs that reaction?
Right. What is the actual driver?
Exactly. I take the position that underlying financial details and forward-looking corporate guidance drive these moves.
And I take the opposing view, which is that pre-event market expectations, trader positioning, and psychological exhaustion dictate the outcome, regardless of the underlying data.
Okay, so let's lay out our frameworks clearly. My argument is that markets act as rational, forward-looking mechanisms.
So accounting engines.
Basically, yes. For anyone listening, let's break down what a discounting mechanism actually does. It means the market does not care about the money a business made yesterday. Institutional models mathematically project how much cash a company will generate over the next 5 to 10 years.
Right, they forecast it out.
Yeah, and then they apply a discount rate to translate that future cash into today's dollars. So when a headline says a company achieved record profits, well, that is looking backward.
It's in the rearview mirror.
Exactly. The market is looking forward. It reacts to the underlying details. If revenue beats forecasts while profit margins decline, or if earnings rise but cash flow generation disappoints, the stock falls for a very logical reason.
You think it's just processing the spreadsheet?
I do. The market is digesting the exact data points that determine future valuations. It is a precise response to guidance on future margins, costs, and customer activity.
See, I look at this through an entirely separate lens. Price action is dominated by expectations and positioning that operate, well, almost independently of a company's detailed guidance.
Independently? That's a strong claim.
But it's true. If an asset has climbed steadily for 6 weeks prior to an earnings announcement, the optimism for that company is already reflected in the price. The event itself simply removes the catalyst behind the earlier rally.
So they just dump it?
Yeah, this prompts traders to sell the news. Even with impeccable underlying financial details, an asset will fall if the expectations were simply too elevated before the announcement was made. The mechanics of the participants override the reality of the spreadsheet.
I hear your point on expectations, but, that assumes the market is ignoring the actual business. Let's look at the anatomy of these bearish reactions to good news.
Okay, let's look at it.
The issue is not just that expectations were elevated. It is that headlines actively hide weaker realities. Consider the actual mechanics of corporate reporting.
Right, the press releases.
Yeah, a management team releases a press statement praising their current performance, which generates the bold, positive headline you see on financial news networks. But simultaneously, hidden deep in the supplementary materials, they warn about slower growth.
Or higher costs.
Right, rising material costs or softer consumer demand in the upcoming quarter.
Okay, but do you really believe human traders are meticulously parsing every single sentence of that supplementary material in real time? Because I would argue they are simply executing pre-planned exits since the catalyst has passed.
Well, maybe a retail trader sitting at home isn't reading it that fast, but the algorithmic models and institutional analysts driving the actual market volume absolutely are.
The machines are reading it, sure.
Let me offer an analogy to explain how this works. Reading the headline is like looking at a restaurant's exterior. It has fresh paint, bright lights, and looks incredibly inviting.
I like this. Okay.
But analyzing the cash flow expectations and margin changes is like inspecting the kitchen. The market sells off because it checked the kitchen.
And found rats?
Basically, if the kitchen reveals that the cost of ingredients is rising rapidly and customer reservations for next month are slowing down, the beautiful exterior no longer justifies the valuation. The sell-off isn't arbitrary.
It's calculated.
Yes, it is a rational recalculation of future cash flows based on those new cost inputs.
That is a compelling analogy, but your premise assumes the market is primarily an accounting machine. I argue it is actually a psychological arena. Let's look at the strict rules of price action in liquidity.
All right, laid out.
If excellent news cannot push an asset higher, it proves buyers are already exhausted. This exhaustion occurs mechanically. Let's use a mental model. Imagine a stadium with 10,000 seats.
Okay, 10,000 seats.
If 9,900 people are already sitting down before the concert starts, you only have 100 tickets left to sell.
Right.
It does not matter if the band is the greatest in the world. Your upside is physically capped at 100 tickets. That is what happens when a stock runs up 20% before an earnings release.
The buyers are tapped out.
Exactly. The participants who wanted to buy have already bought. They have allocated their capital.
You are describing a vacuum of buyers. But wait, let me pause you right there. If the underlying data in the report is flawless, if the kitchen is perfectly clean and margins are expanding, why wouldn't new capital enter the arena?
Because they are exhausted. They have run out of capital to deploy at that specific valuation.
At that exact moment, you mean?
Right. Therefore, the specific warnings about growth or costs that you mentioned are secondary to the mechanical reality that the buyers are simply tapped out. The news was already priced into the asset.
So the event is just an excuse to sell.
Yes, the event happens, the uncertainty is removed, and the people sitting on substantial profits begin to take them, creating downward pressure. The underlying data could be entirely flawless, and the asset would still drop because the mechanics of positioning demand it.
I just can't buy that the math completely goes out the window.
It doesn't go out the window, it's just secondary.
But the reason new capital does not enter isn't just a blind lack of money. It is a lack of capital willing to buy at that new valuation given the detailed financial realities.
You think it's a conscious choice?
Absolutely. If the forward guidance indicated even higher future yields, institutional funds would reallocate capital from other assets to buy this one. The sell-off happens specifically because of the margin compression or the cautious guidance.
Well, I would argue the new capital is waiting for the precise pullback we are describing. But let's look at the inverse scenario, which I think illustrates the power of positioning even more clearly.
You mean bullish reactions to bad news?
Exactly. This happens constantly, and it defies the rational accounting model you were proposing.
You were talking about the classic relief rally?
Yes. When fear becomes excessive, objectively bad news pushes prices higher. If an asset has already fallen heavily over consecutive months, investors are positioned for an absolute disaster.
They're bracing for impact.
Right. Let's walk the listener through the mechanics of forced buying. When institutional funds heavily short a stock, they borrow shares from a broker to sell them, hoping the price drops so they can buy them back cheaper later.
Standard short selling.
Standard short selling, but they owe the broker those shares. When a weak report comes out, sales are lower, margins are shrinking, but it merely avoids the worst-case scenario, the price stops dropping. Bargain hunters step in.
Because the actual result is less damaging than the models predicted.
Mechanically, yes, but here is the crucial part. As the price starts to tick up just a little bit, the brokers who lent the shares to the short sellers issue margin calls.
Oh, the squeeze.
The squeeze. They tell the short sellers, you need to close your position right now. To close a short position, you are forced to buy the stock. It is not a choice.
You just have to buy it at whatever price.
Exactly. You have all these short sellers forced to buy at the exact same time, which drives the price up faster. That upward momentum triggers even more margin calls for other short sellers, forcing more buying.
It becomes a feedback loop.
A localized panic loop. Add in some speculative buying, and you get a powerful rally on terrible financial data. The details of the report do not matter. The mechanical avoidance of catastrophe matters.
I see the mechanics there, and I agree, short squeezes are a real structural phenomenon. But let me challenge you by pivoting to macroeconomic data.
Okay, let's zoom out
Because we see this exact same counterintuitive reaction in the broader economy, and it actually proves my point about forward-looking rationality. Consider a weaker jobs report or slower inflation data.
Which is bad news for the broader economy. Fewer jobs being created?
Exactly, bad news for the economy, but the equity markets will often rally on that news. Why?
Because of the Fed?
Yes, because a weaker jobs report increases the probability of interest rate cuts by the central bank. Slower inflation reduces the pressure on monetary policy. The market rallies not because of a mechanical short squeeze or exhausted sellers, but because of math.
Meaning the cost of capital.
Exactly. When the central bank cuts rates, the cost of borrowing drops for businesses. More importantly, lower interest rates mean the discount rate applied to future cash flows is lower.
Which props up the valuation.
Mathematically, that makes future corporate profits more valuable in today's dollars. So when weaker economic data directly supports equity valuations through monetary policy expectations, isn't that a clear case of the market correctly pricing forward-looking realities rather than just executing a mechanical relief rally?
I'll admit that is a well-constructed point. I agree with the outcome regarding interest rates. But whether we are discussing macroeconomic data or corporate earnings, the smartest question a practitioner can ask remains the same.
Which is
this better or worse than what the market had already priced in?
You are talking about the consensus estimate.
I am talking about both the official consensus estimate and the whisper numbers.
The unofficial expectations.
Right. There is the official estimate that gets published, say 50,000 jobs created. But the real market expectation, the informal whisper number passed around trading desks, might be 70,000.
Okay, so a higher bar.
Exactly. If the actual number comes in at 60,000, the market beat the official estimate. The headline looks fine, but it missed the whisper number.
Because the positioning was built around 70,000.
Precisely. The institutional positioning was built around 70,000 jobs. So the market sells off. Yes, the market is pricing in the probability of rate cuts, but the relief rally only happens if the jobs report is weaker than the baseline expectation.
So the reality is secondary to the expectation.
The absolute number, the rational reality, is completely subservient to the pre-existing expectation.
I can see that the consensus estimate sets the baseline. You cannot analyze a report without knowing what the market expected to see. But the market's reaction from that baseline is still a rational recalculation driven by details.
Driven by how those details relate to the expectation.
Fair enough. Taking all this theory, this battle between granular data and exhaustion, how does a trader actually survive earnings season without getting crushed by these traps?
It is the hardest part of the job.
Long trade, or negative words mean a short trade, is the most common error. My framework focuses on meticulous preparation regarding the data.
And my framework focuses entirely on pre-event behavioral clues and price action.
Well, let me outline the data-driven process first. To avoid the headline trap, one must systematically check consensus estimates and review previous corporate guidance before the event occurs.
You have to do your homework.
You have to know what the management team promised 3 months ago. Then, when a news breaks, you must immediately separate the headline from the underlying details. You're not looking at the revenue beat, you're looking at operating leverage.
Give me an example of that.
Okay, a company might announce record revenue, which sounds great, but if you look closely at the details, their cost to acquire a customer has doubled. That means their operating leverage is degrading.
So they are spending too much to get that revenue.
Exactly. The models instantly recognize that to grow revenue next year, the company will have to spend an unsustainable amount of capital. You have to analyze customer activity metrics and cash flow expectations before you commit capital.
Look, I hear that, but that assumes you have the analytical processing speed to digest operating leverage and customer acquisition costs faster than algorithmic trading systems.
It takes discipline, sure.
But most humans do not have that speed. I approach it from a different angle. You must review the chart before the event. You're identifying the likely positioning.
Looking for the stadium full of buyers.
Exactly. If an asset has climbed steadily for 6 weeks heading into a report, you must assume optimism is maximally priced in. You have a stadium full of buyers. If the market is universally leaning one way, the most profitable trade is often in the opposite direction.
That is a fair read of the pre-event setup. The chart reflects the expectations, certainly, But the confirmation of whether that expectation was correct comes from the post-event price action relative to the forward guidance.
Yes, post-event action is key.
We both agree on the concept of price confirmation. You must avoid chasing the first reaction. The initial move is often just noise.
Absolutely. The first reaction is emotional, algorithmic, and designed to trigger stop losses. The real information comes shortly after the dust settles.
When the market actually digests the report.
Right. For instance, let's look at price confirmation. If a company releases a terrible report, missed revenue, declining margins, and the stock initially dips but then refuses to push lower, that is crucial information.
It shows resilience.
Terrible news failing to push an asset lower shows that sellers have completely run out of conviction. It signals underlying strength as the asset holds structural support levels.
And the inverse is equally true. If a company reports strong results, beats estimates, but then breaks down below key support levels, it signals that expectations were misaligned with the actual forward guidance.
The kitchen was dirty.
The kitchen was dirty. Perhaps management praised demand, but their specific margin guidance for the next quarter indicated rising material costs. The breakdown confirms the market has digested the kitchen, so to speak, and found it lacking.
Or it confirms that every single buyer was already fully invested, and the mere absence of an upside catalyst forced them to liquidate.
We just keep circling this central tension. Is the engine driven by the fuel of the data or the mechanics of the pistons?
I'm sticking with the pistons.
Let's examine the concept of support and resistance in this context. Marking these levels before an announcement is critical. If an asset sells off on a positive headline but holds a major support level, what is your interpretation?
My interpretation is straightforward. The sellers who panicked at the lack of a continued rally simply ran out of volume.
Just volume.
Yeah. The existing limit order sitting at that support level absorbed the blow. It is purely mechanical. There is no grand recalculation of discounted cash flows happening in 30 seconds. It is just order flow and liquidity.
I am not convinced by that line of reasoning. Institutional capital does not place multi-million-dollar limit orders based purely on abstract lines on a chart.
They do it based on risk management.
But they don't just draw a line at $100 and say, we will buy here because the line is pretty. That $100 mark is the exact price where their quantitative models dictate the company's projected cash flow yields a targeted annual return.
You think it's always tied back to the models?
Always. The structural support exists because the underlying details justify the valuation at that specific price. The mechanics serve the underlying details.
But those quantitative models break down when fear takes over. We have seen assets trade well below their intrinsic cash value simply because funds were forced to liquidate due to margin calls.
Sure, in a crisis,
In those moments, the underlying details are entirely meaningless. Survival dictates the trade, not guidance. When a fund is forced to liquidate its portfolio to meet a margin requirement, it sells good assets and bad assets alike. The spreadsheet does not matter.
okay, but those are extreme edge cases. During a severe liquidity crisis, yes, correlation goes to 1 and everything sells off.
It happens more than you think.
Maybe, but in the standard operation of the market, a typical earnings season or economic data release calendar, the details dominate. Let's review the key details that actually move the needle when a report is released.
Okay, let's hear them.
It is not just about top-line revenue and bottom-line profit. It is management's explicit view of future demand. It is the granular changes in operational costs.
I agree those granular metrics are reported and analyzed, but I maintain they only matter in relation to what was expected. Let's use an example.
Go for it.
If management states that consumer demand is strong, but the market consensus expected them to say demand is unprecedented, the stock will fall.
Because it was a downgrade in sentiment.
Right. The word strong is objectively positive, but the delta between the expectation and the reality is negative. The market trades the delta.
And the delta is precisely why we must avoid assuming positive words automatically equate to a long trade. We have established that clearly.
Right, you can't just read the headline.
To navigate this, the process we discussed is vital. Check the official estimates, identify the whisper numbers, review the prior trend to gauge exhaustion.
Separate the bold headline from the granular metrics like operating leverage. Mark your structural support and resistance levels. And above all, wait for price confirmation after the initial emotional reaction.
On that, we are in complete alignment. Understanding whether the market received a positive or negative surprise is entirely different from assessing whether a news release merely sounds good or bad to a lay person.
Exactly. The goal is to identify the underlying truth of the market's reaction, independent of the press release.
Yes.
Our frameworks emphasize different drivers, but the phenomenon we're describing requires immense discipline to navigate. The seemingly illogical reactions of financial markets, selling on good news, rallying on bad news, are actually deeply rational when viewed through the correct lens.
Depending on what lens you use, of course. Right. They are driven by the market's role as a forward-looking discounting mechanism. Underlying details such as precise revenue guidance, margin adjustments, and management's granular view of customer activity provide the logical basis for these moves.
The fundamental thesis.
Yes, the market ignores the superficial headline and mathematically prices in the future reality.
And from my perspective, the overriding forces are expectations, market positioning, and the removal of uncertainty. A market reaction is rarely about the absolute quality of the financial data.
It's about the expectation.
Exactly. It is about the data relative to what was already priced into the asset. Exhausted buyers will sell good news because they lack capital, and trapped short sellers will buy bad news because they are forced to cover. The mechanics and psychology of the participants dictate the direction far more than the corporate fundamentals.
Despite our different approaches to the mechanics, we reach a clear point of convergence here. We both agree that assuming a positive headline guarantees a rising price or a negative headline guarantees a falling price is a catastrophic trap.
A very expensive trap.
Very. Success requires avoiding the immediate emotional reaction, mapping out structural support and resistance levels, and demanding price confirmation before committing your capital.
Absolutely. The smartest question you can ask yourself when reviewing a report is never, is this news good or bad?
No, that'll get you in trouble.
The only question that matters is this data better or worse than what the market had already priced in?
The market is an endlessly sophisticated engine, constantly weighing behavioral expectations against granular reality. It demands rigorous analysis and a refusal to take information at face value.
You have to dig deeper.
So the next time a major announcement breaks and you see the bold text scrolling across your screen, ask yourself, are you just reading the sign on the door, or are you ready to inspect the kitchen?